Kipp, thank you so much for joining us. You know, Ray Dalio went so far this morning as to tell everybody here, don't buy bonds. What are you telling your clients?
So in our fixed income business, I think what he's referring to is a little different than the types of assets that we're managing. So most of our credit business is corporate and asset-based, higher yielding, a lot of it illiquid. So I think what he was probably getting at, not having seen the interview, was telling the same thing to a lot of folks that we're telling our clients, which is with such low yields, it's very difficult to be in cash. It's very difficult to be in low yielding, government mortgage bonds, and probably high-grade corporates, too, because of the duration, maybe the outlook for the Fed, and the fact that it's just really difficult to earn any return there at all.
Well, how sensitive are credit markets, especially the riskier parts of the credit market, sensitive to what the Fed says?
They tend to be less sensitive, right? So the rate kind of influences a lot of these shorter side of the curve types of investments, which really isn't where we spend our time focusing in alternative credit and other areas. What we do is much more fundamentally driven. And a lot of the funds that we manage are taking much longer term bets. So we feel much less sensitive, maybe to a change in policy tomorrow or even a short term, coaching from the Fed tomorrow about where rates may go.
But do you have any concern, seeing that the junk bond market has jumped back so fast, so hard, about what the longer term impact these low interest rates are having on the market and asset prices?
Yeah, I think the key for us is we're seeing investors generally wanting to earn some sort of durable premium yields, right? So a play even into the junk bond market is saying, I don't want to be into the short side of the fixed income markets. I'm willing to take more credit risk. The question is, are you taking it well, right? Are you taking it responsibly? Are you doing a good job underwriting potentially future defaults, right? Which inherently, I think with the amount of debt that's come in are there. But, that's our job as a manager, obviously. That's why you pay for active management, to get folks that understand how to do the work and how to underwrite.
You once told me that you spent a lot of your time saying no, right? And there's a lot of folks that have said lately this default cycle is just too good to be true. Do you agree with that there's risk under the surface that perhaps investors are not either being paid for or are not accounting for?
Yeah, that's always the risk, and you're trying to forecast, or as you're underwriting, a quality and strong underwriting, right? For our illiquid credit investments, we built these huge origination teams that allow us to see a ton of opportunities, and we do say no a lot. It's actually the hardest part of our business, getting people to continue to show you deals when your hit rate's probably 5% of what you're seeing. Mm-hmm. Look, I think being in defensive industries, being in solid companies, investing with the right management teams, and in particular, because we have large portfolios, sticking with your winners, kind of playing off your incumbency positions, is how we have advantages versus others that are just purely in the market.
Now, you're playing different roles in the market. One of the hottest things this year in private credit has been this unitranche deal, this melding of credits. And so we've seen a deal as big as $3.5 billion almost. Are there more deals like that in the market, and how big can they get?
Yeah, I think what's happened over the years is there's been a increased size where the banks really see easy syndicated, leveraged finance transactions, right, where you can rate them, you can sell them, et cetera. And the opportunity for us in our private capital businesses has been to build the capital scale so that we actually have an interesting alternative, whether it's to a private equity buyer or a family or an entrepreneur, or even elsewhere outside of the corporate credit space, right? And we've now built the tools to do these bigger deals, but it's 10 plus years in the making, right? The unitranche was sort of invented to do transactions like this years ago, and we've marked different levels, right? There was a $100 million deal, then there was a $500 million deal. We did the first $1 billion deal, I want to say 6 or 7 years ago. And now all of a sudden it's commonplace that the market supports multi-billion-dollar transactions. So I think they're very much here to stay.
Right, not too far from getting to the next $4 billion deal.
I think the reality is there are plenty of folks like Ares and some of our friends and competitors that can easily hold $800 million to $1 billion on a single transaction basis. Putting a club of those folks together to do a $3 or $4 billion deal just is not that complicated anymore. Whereas 5 years ago, it was super difficult.
Of clubs, you're partnering with banks these days, too. Are you seeing yourself partner with banks more on LBOs as they get bigger?
So, typically the banks are underwriting the bigger deals where they're achieving a lower cost of capital by doing an underwrite and syndicate type of transaction, right? Where it's rated, it's getting sold to institutional buyers that really aren't originating that paper. They're buying it from the banks. we've got obviously, tremendous relationships with all the banks. The way that they tend to access us in our middle market businesses and in our asset-based businesses is they actually lend us substantial capital because we do use modest leverage, right, to make our investments.
Right.
The way that they've reoriented themselves over the years is really to partner, I think, with folks like Ares as a lender and as a wholesale financier of what we're doing.